Hi and welcome to Swissquote's Daily Market Talk. It's Friday, May 16th. A week full of hope and trade deals is coming to an end with relatively optimistic investor sentiment, yet the unideal news and economic data point at looming risks. So, the US dollar remains under pressure while gains in the equity markets look more contained in the lack of new catalysts. So, we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So market sentiment remained tilted toward the upside across the US and European equity markets yesterday. In Europe, the British growth and the eurozone industrial production data surprised investors to the upside and gave a certain boost to the European bulls who see the European economies benefit from lower energy prices and relatively stronger local currencies to deal with their inflation battle and help their economies deal with the trade war. So combined with the prospects of ample government spending, we could now see growth in Europe improve. That's the basic thinking. And yesterday's numbers somehow supported that very view of the first quarter. The first quarter growth in the eurozone was softer than expected, mind you, but the industrial production data made a nice progress. So there is hope there, even though the hope is getting a little bit weaker by the day as there is no progress on the regulation side, but that's another story. Now, across the pond, the news were less enchanting for sure. The US retail sales decelerated significantly in April. The US factory production declined for the very first time in 6 months, and confidence among the US home builders worsened. So the only bright spot in that data was the dramatic easing that we saw in the US producer prices, because the yearly figure fell from 3.4 to 2.4%, a full percentage point, and the monthly number printed deflation of 0.5%. So some analysts started screaming that the latter numbers point at slowdown for the US economy, but not stagflation, meaning that the Federal Reserve could lower the interest rates and I'll try to turn the tables around. As such, the US 2-year yield was pulled lower yesterday below the 4% psychological mark and brought the possibility of a July rate cut on the table. Yet, wait, it's not that simple, because Walmart, then the US retailer known for proposing low prices to its customers, came out yesterday and said that they will be raising the prices of their products in accordance with the tariffs. Not all products will see their prices rise happily, because the company will apparently try to spare food prices from tariff-led price increases, but for the rest of their products, depending on their sources, there will be inflation. A 30% tariff, for example, on products that come from China could lead to double-digit price increases, warned the company. So that's pretty much in line with both slower spending and higher inflation narrative for the US that the Fed will probably find hard to deal with. So if you ask me in which camp I am, I would probably say that I'm closer to the stagflation camp than to the Goldilocks. Everything will be fine despite the trade war camp. And despite the lower recession bets since the beginning of this week, since the de-escalation that we saw in US-China trade tensions and the Middle East deals, the economic worries for the United States will probably remain until more clarity. So the news will continue to be hectic. I have no doubt about that, because Trump said yesterday, for example, that he had a problem with Tim Cook, that he does not want Apple to move its production to India. I think Tim Cook also had a problem with that, because Apple has been moving its production from China to India to comply with Donald Trump's will to get the company out of China. And now he doesn't know what to do, because producing iPhones in the United States And selling them for 3,000 US dollars per phone is obviously not a viable business solution. So the picture is getting dark again. Interestingly, Apple shares fell only 0.41% yesterday on the news, maybe on disbelief of the news, or maybe on the lack of alternative scenarios to help Apple get away with the US manufacturing ambitions. I don't know, but the things are not really looking good for companies who do have international and complex supply chains. Elsewhere, Nvidia consolidated gains yesterday on worries that some people at the White House are now concerned that the huge sales deals to the Middle East would go against their national security program, their national security purposes, and benefit China. Overall, the S&P 500 started the session with limited appetite, but still managed to find buyers throughout the session, hinting that appetite somehow improves and remains strong, and that despite unideal news. But gains are certainly at risk of trade news and trade policies, and the fact that the S&P's low volatility ETF jumped nearly 2% yesterday, which is a good jump for S&P's low volatility companies, could be a sign that the winds could start turning around in the lack of further good news or further catalyst on the trade front. In the FX markets, the US dollar index remains under pressure, and the US dollar's weakness is actually becoming a serious headache among foreign investors who didn't necessarily feel that need to hedge against a weaker dollar in the past few years. Simply because in times of market turmoil, so market sell-off and high volatility like the one that we see today, the US dollar would gain thanks to safe haven flows, so you don't need to hedge against it. But recently, the US dollar has been weakening as the volatility increases across the board, and the latter increases the hedging costs, hedging needs, and the hedging costs, leading to an unusual negative correlation between the US dollar and volatility. So what it ultimately warns that, given how the global portfolios are heavily invested in US companies and do have this US dollar exposure, hedges against US dollar could further weigh on the dollar's valuation in the medium run, because people will be going and hedging themselves against a further fall in the US dollar. In the short run, the US dollar's broad-based retreat helped obviously the major gain some ground. The euro dollar in this respect rebounded past the 112 level yesterday after having tested its 50-day moving average to the downside earlier this week. Now, despite a set of stronger than expected inflation reads in the major eurozone economies, the shiny industrial production numbers yesterday brought the euro bulls back to the market. And sterling also extended gains against a broadly weaker US dollar, while the Japanese yen printed a very clear advance against the greenback this week. The latter may have weighed on the Nikkei index, mind you, throughout the week, but the Japanese blue chip index is preparing to close a bearish week in opposition to its European and its US peers, but still above its 100-day moving average. Let's see what next week brings to the Japanese markets. Now in China, Alibaba's profit missed estimates yesterday and led to 7.5% sell-off in the company's share price. Now, part of the reason was the gloomy consumer spending in China due to the tariff war, but the part of it was the company's decision to divest from some of its subsidiaries and the valuation of its equity holdings. So the situation is not that bad, and the company's cloud revenue, mind you, accelerated in the first quarter of this year thanks to AI, as a sign that AI story in China is developing and there is a growing demand for AI. And the CEO Eddie Wu said that their AI related product revenue achieved triple-digit growth for the 7th consecutive quarter. Well, they didn't really specify which product they were talking about, but they said that the AI demand remains strong. Well, although investors are kind of discouraged by the numbers that Alibaba announced yesterday for the first quarter, well, the developing AI story for China, the various stimulus measures from the Chinese government and the People's Bank of China to boost the Chinese consumption, and a possible de-escalation of the trade war with the United States remain supportive factors for Alibaba and its share price in the medium run, in my opinion. As such, the price pullbacks in Alibaba's share price could still be interesting opportunities to buy dips. So from a technical perspective, Alibaba actually managed to defy the bears into the $100 per share level at the heart of the trade storm with the United States and rebounded 40% from dip to peak. So the positive trend will remain intact above the $120 per share level. And for investors who are looking for cheap deals, well, Alibaba could still be an interesting play. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.